Hello, everyone. Welcome to this discussion on the sale of personal residence. Before we start learning about any new tax concept, it's a good idea to have a look at the federal income tax formula and try to identify where in the formula does this concept fall. So, for the purposes of this discussion, we will just focus on the very top two lines of the formula. We have our income broadly defined, and then we have exclusions. This discussion is about one type of exclusion. And this exclusion is due to section 121 in our tax code. It applies to the sale of your principal residence, that is your main home, not a rental or a second home. The second condition here is that you must have owned and used the home as your main home for at least 2 out of the last 5 years. So that's ownership rule and the use rule. The next condition is that you can use the exclusion only once every 2 years. And lastly, there is no exclusion for losses, and the gain is the only thing that can be excluded. Now, this is something that my students sometimes struggle with. Like, what does it even mean to say that no exclusion for losses in this context? To understand what that really means, we again have to go back to our federal income tax formula. Here we can see that once we arrive at our gross income, then we can take some deductions. And the first deduction we can take is the above the line deduction. If you have a capital loss, for example, in your investment, you can deduct up to $3,000 of those losses, those capital losses, as above the line deductions. Now, you can also deduct your business losses as above the line deductions. Here, all this bullet point is saying is that unlike some of those losses, the loss on the sale of a personal residence cannot be taken as an above the line deduction. There is this section 121 applies only for the gains that we make, but not for the losses. Now, there is a maximum amount of gain exclusion that we need to be aware of. For single filers, the maximum of gain that you can exclude is up to $250,000. And if you are married filing jointly, then the maximum limit is $500,000. Now let's look at an example. Tina is single and sells her principal residence. She owned and lived in the home for 4 years. Now that's a good thing. Because she lived and owned in the home for 4 years, Tina meets both the use test and also the ownership test because she owned it and used it as her principal residence for 4 years. Now, the next part says the sale results in a $400,000 gain. Tina has not used the Section 121 exclusion on any other home sale in the last 2 years. That's also good. How much of the gain can Tina exclude from her income and how much is taxable? So let's look at these two parts of the problem step by step. Let's think about the exclusion amount. Because Tina meets both the ownership test and also the use test, she can exclude the maximum amount, which is $250,000. So that's her exclusion from her income. Now, let's think about the second part of the question, which asks about how much is taxable. Now, that's a different question. The amount that's taxable is equal to the total gain or the overall gain, which is $400,000. And from there, we exclude the amount that she qualifies for, and she qualifies for the maximum amount for a single tax filer, which is $250,000. Once we do the math, we see that her taxable amount is $150,000. So that's the taxable amount. Now, what if you do not meet the ownership and the use test? That is, you have not owned the home for 2 years, or maybe you owned the home for 2 years, but you did not live there for 2 years. In that case, you may qualify for partial exclusion. That is, rather than getting the full exclusion, you might get some partial exclusion. Now, you will get the partial exclusion only if you meet certain conditions. Otherwise, you'll get nothing. Certain conditions include change in job, some health conditions, or unforeseen circumstances. Under these cases, you may get a partial exclusion. And the formula that we are going to use for partial exclusion is $250,000 times months of use divided by 24. So this is the formula that we are going to use for both single tax filers and those married filing jointly. And if we are using married filing jointly, we just have to use this formula separately for the two spouses. Again, we have to remember that the maximum exclusion per spouse is $250,000. Now, let's look at another example. It says Harold and Carla are married filing jointly. Harold has owned and used the home as their principal residence for 5 years. Now, that's the good news. Just by reading this much, you can tell because they meet both the ownership and the use test, they lived there for 5 years, they had to live there and owned that home for 2 years, but Harold has exceeded that amount. And that's why Harold qualifies for the full $250,000 gain exclusion. Now let's think about Carla. Carla moved in and began using the home as their principal residence 18 months ago. Now, by reading this much, you should be able to figure out that Carla does not qualify for the full exclusion amount, but they might qualify for partial exclusion amount if they meet a qualifying condition. Okay, now let's keep reading the question. It says they sell the home and realize a $600,000 gain. The sale is due to Harold's job relocation to another state. Now, that's a qualifying reason, and that's why Carla might get the partial exclusion. Then it says neither spouse has excluded gain on the sale of a principal residence in the last 2 years, and that's a good news, so that they now can qualify for the gain exclusion. How much of the gain can they exclude from income and how much is taxable? Again, this question has two parts. Let's do them one after the other and do them step by step. Let's think about Harold again. As I have mentioned before, Harold meets both the ownership and the use test, and that's why Harold qualifies for the full gain exclusion amount, that is $250,000. And for Carla, because there is a qualifying reason, that is due to job relocation, they have to sell the home. And although Carla did not live there for 2 years, still Carla can get some partial exclusion. We are going to use that formula. In the formula, we have $250,000. That's the theoretically maximum gain exclusion per spouse, times the number of months that this spouse has lived in the home, that is 18, and divided by 24. Again, 24 is part of the formula. Once we do the math, we get 1,875,000. So that's the exclusion for Carla. Now, if we think about their total exclusion, we just add the two numbers up, and that brings us to our total exclusion of 437,500. That's the total exclusion. Now, you realize that if Carla lived there for 2 years, then their total exclusion would have been $500,000. Now, let's think about the second part of the question, which asks how much is taxable. To figure out how much is taxable, we need to figure out the full gain amount, which is $600,000, which is the overall gain amount. And then from there, we subtract our exclusion amount, the total exclusion amount, as we calculated in our first part. It was 437,500. Once we do the math, we get 162,500. So that's the amount that's taxable to them. Now, please pay attention to what the question is asking. Again, sometimes what we do is that we memorize this complex set of rules, we do the math correctly, but because we do not read the question carefully, we select the wrong answer. So here, if the question asks how much of the gain is excluded from income, then the correct answer will be 437,500. That's option B. On the contrary, if the question asks how much of the gain is taxable, then the correct answer would be 162,500 or option A. So as you can see from this example that just one little thing changes in the question and the correct answer changes. And that's why we have to read carefully what the question is asking for. Now let's think about the potential hardest question from this concept that I can think of. Rather than asking about how much gain is excluded, how much gain is included, what if the question asks how much is the tax liability from this transaction? And the question gives you another piece of information, that is, assume they are in 24% marginal tax bracket. Now, this is where I want to pause and I want to think about why this information, although necessary, can be potentially misleading. Okay, I'm assuming you thought about it. Now, many of my students make a mistake in applying the appropriate tax rate when they're solving a problem like this. They do get the formula correct. That is, tax liability is equal to taxable gain times tax rate. Here, the taxable gain, they correctly calculate 162,500, but they apply the wrong tax rate. They apply 0.24, which is the wrong tax rate. And the reason that it's the wrong tax rate is that here we are dealing with a capital gains situation, and this 24% should be applied to our ordinary income, not to our long-term capital gain. When we have a long-term capital gain, in this case, Harold and Carla have a long-term capital gain situation, they don't have to apply this higher marginal tax rate. They actually can apply the lower long-term capital gains rate. So that means we need to figure out what will be their long-term capital gains rate. For that, we can use this table that will be provided to us during the CFP exam. The first thing we do is we look at this 24% marginal tax bracket, and we look at the range of taxable income. And the range of taxable income is above $200,000 and above $400,000. Then we need to figure out for this group of people what will be their long-term capital gains rate. Now, these are people who are married filing jointly. So we look at this table below, these long-term capital gains rates. And for married filing jointly, it says that above 98,901 to 613,700 for taxable income in this range, the long-term capital gains rate is going to be 15%. So we can easily identify that these group of people who have taxable income little above 200,000 and little above 400,000, they fall within this range. And that's why their long-term capital gains rate is going to be 15%. That means to get our correct answer, we have to apply a 15% tax rate. And once we do that, we get to our correct answer, which is 24,375. So the correct answer here is option B. So I hope this example was useful for you to see where you could be potentially making a mistake. So please read the question carefully, try to answer what the question is asking for, and also always pay attention to the appropriate tax rate. Is it an ordinary income situation or is it a long-term capital gains situation? Depending on that, apply the appropriate tax rate. This brings me to the end of this video, and I hope to see you guys in the next one.